Hello and a very warm welcome to Chartered Accountant's Pen. I'm so glad you're here. In this video, we're going to demystify the practical application of IFRS 9 by walking through the key journal entries for its three main pillars: classification and measurement, the ECL impairment model, and hedge accounting. Whether you're a student or a professional, this will clear things up. Let's get started. Here's our game plan. First, we'll tackle how to account for the initial recognition and subsequent measurement of financial assets under the three IFRS 9 categories. Then, we'll move on to the expected credit loss model and how to book impairment losses. Finally, we'll conquer the journal entries for a simple cash flow hedge. Stick around, it's going to be insightful. IFRS 9 classifies financial assets into three categories based on business model and cash flow characteristics. Each category has different journal entries for subsequent measurement. Let's look at examples for each. This is straightforward. You debit your financial asset and credit cash. The key is designating it to the amortized cost category from day one. Subsequent measurement involves accruing interest revenue using the effective interest rate and recognizing any discount or premium amortization. Here, since it was purchased at par, it's a simple interest accrual. For this FVOCI equity investment, the initial entry is the same. The magic happens at year end. The fair value gain is booked directly to other comprehensive income, not the profit and loss statement. For assets at fair value through profit or loss, like this trading security, all value changes hit the P&L immediately. Here, we recognize a $2,000 loss. Now, let's tackle impairment under the expected credit loss model. The journal entry depends on whether the instrument is in stage 1, 2, or 3. We'll look at a stage 1 example. This is a crucial entry. We debit an impairment loss in the profit and loss statement and credit a loss allowance account, which is a contra asset to the financial asset, reducing its carrying value on the balance sheet. Finally, hedge accounting. It can get complex, but let's simplify it with a classic example. A cash flow hedge against a future foreign currency purchase. At the start, the fair value of this forward contract is typically zero, so often no journal entry is made. But we must document the hedge relationship. This is the key entry for an effective hedge. The gain in the derivative is recorded, but the credit goes to a special equity account called Cash Flow Hedge Reserve in OCI, not to P&L. This avoids P&L volatility. When the hedged transaction affects P&L, in this case, when the inventory is bought and eventually sold, we release the reserve. We reclassify it from OCI to adjust the carrying amount of the hedged item, here decreasing the inventory value. This effectively locks in the hedged rate of 1.10. Now, let's settle the derivative contract itself. The entity receives cash of $30,000 from the counterparty because the contract was beneficial. We must now remove the $20,000 forward asset that has been sitting on our balance sheet since December. We do this by crediting the forward asset account for its full $20,000 carrying value, which zeroes it out. The difference between the cash received and the asset's value is the final $10,000 gain, which we now recognize in profit or loss. This final gain was not previously recognized in OCI because it occurred after the last reporting date. And that's a wrap. We've covered the crucial journal entries for IFRS 9. I hope this breakdown was incredibly helpful for your studies or your work. If it was, please do us a huge favor. Hit the like button, subscribe to the Chartered Accountant's Pen channel for more content like this, and share this video with your friends and colleagues. It really helps the channel grow. Thanks for watching, and see you in the next video.